Well, hello, everybody. This is Dave Berkus with the Berkus Report for Eye on Business. This week, we're going to talk about a subject that I hope will be important to those of you who are entrepreneurs. What do you give up when taking outside money? Taking an angel or venture investment requires setting an entrepreneur's expectations that may come as a shock to some at first. From the moment that such an investor looks seriously at your company, the investor or VC is looking at the end game, the ultimate sale of the company, and in the eventual initial public offering. There is just no middle ground. Taking money from these sources involves resetting priorities over time. There's no such thing as a lifestyle business with outside investors. To protect against such an event, outside investors often have documents which allow the investor to put the stock back to the company after 5 or so years, requiring the company to pay back the investment plus dividends accrued if this company is not sold or if it is not public. The sword hanging over the company is not often used, but is a constant reminder that outside investors are serious about getting their money back sometimes, hopefully in less than 5 years, hopefully at a profit, and usually from the sale of the company. Many companies find themselves at the 5-year point completely unprepared for a sale and without the cash resources to carry out such a repurchase of investor stock. That makes the clause moot, of course, but it is something to remember. There are also clauses in many of these documents that allow the investor to override the founder and force a sale of the company if a proposed sale is attractive enough to the investor for liquidity, even if the founder feels there is a much more potential if the business is not sold at the present time. Finally, it's an unfortunate fact that when a company needs money and hasn't met its original planned targets, the newest investor prices the round at a lower price than the last one or the several rounds before it. And that's called a down round, and it's angering and frustrating to the previous investors who took what they perceived as the greatest risks by investing before the business proved successful. Well, the last money in does have the first say in valuation and sometimes forcing draconian terms that require prior investors to contribute a proportionate amount, we call it pro rata, to stay in the game at the same level as the new investors. As the years progress with typical VC firms, seeing lower returns than expected from previous years for their partners, such terms are more common in secondary rounds of financing today, creating a real rift between angel investors and the former close allies, these VCs, whom they had once coexisted with as suppliers of deals and suppliers of money for subsequent rounds. So be aware that professional investors are in your company for the eventual large profits at the liquidity event. They're your friends, only as long as you meet or exceed the planned growth or expectations and gain value. They tolerate you and your management when the numbers are a bit murky, but with the explanation that it is believable and correctable. They act in their best interests when things go south. Well, that's just the facts. So be aware, you do give up something when taking outside investors. You also gain the opportunity, of course, with their cash and their expertise to build a company faster and better. It is a balancing act, something we all have to think about. Well, this is Dave Berkus with the Berkus Report for Eye on Business. See you next time.